Hi everyone, welcome to a very special edition of our Inner Circle weekly webinar. I'm Alex King, I'm the founder and CEO of Zeberg Capital Research. We're an SEC regulated investment research business. I have a very special guest today, Henrik Zeberg, to whom I shall introduce you in a moment. And we're going to talk about one topic and one topic only, which is how to spot when the current bull market ends. We're in a raging bull market, as anyone can tell. Bull markets tend to go on for longer than anybody thinks, and they tend to surprise to the upside. But in the end, all bull markets finish, obviously, and roll over, and we see something very different. And most market participants are not prepared for such a change. Most market participants are most bullish right at the end of a bull market cycle. And we want to talk about how to avoid that mistake and how to start to spot the signs of a bull market ending. And I'm going to ask Henrik to do much of that. We run all of our webinars at Zestrian on a live and open mic basis. So I'm going to read out a disclaimer in a moment, and then we'll open mics. And so if anyone has any questions, comments, points, anything at all, please do shout. I shall moderate when Henrik's talking. If you have any questions at all, points, do reach out. These sessions we find are valuable to the extent they're discussions. Speaking of myself, I can talk about stocks and markets literally all day and all night, never get bored. And I think probably the same is true of Henrik as well. But these things are much better when they're discussions. If you can't use audio, do use the comments and the question function in the webinar platform. Again, I'll moderate when Henrik's talking. We'll record the session and we'll post it live. We'll post the recording in a couple of hours once it's all compiled and so forth. In the meantime, let's get going. I'm going to read out a disclaimer and then we shall start. So disclaimer, this webinar is intended for US recipients only, and in particular is not directed at or intended to be relied upon by any UK recipients. Any information or analysis in the webinar is not an offer to sell or a solicitation of an offer to buy any securities. Nothing in the webinar is intended to be investment advice, and nor should it be used to make investment decisions. Zestrian Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stock, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as the webinar's data transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Zestrian Capital Research. Zestrian Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, so we're going to switch microphones on right now. Okay, that's done. And then I'm just going to walk you through what the bull market actually looks like right now. Henrik, who I shall introduce you now, is head macroeconomist at Swissblock. I came across him, let me see, in 2022. And so my own background is as a long-time professional investor, venture capital, leverage buyouts, and then running my own money in public markets. And it's not very often that I find someone that I think whose work is just so different to everybody else's, so convincing that I really start to get into and follow their work. And Henrik was one of those people. In 2022, any of you here who are subscribers to our work will know we were, Zestrian, we called the top of the 21 market really well. I was proud of our work in doing that. Called the end of the 22 bear a little bit early, but we were very, very bullish right at the end of the bear cycle. And there was hardly anyone else I could find that thought that way, which of course makes you question your own judgment. Henrik's work on Twitter and elsewhere was even more vociferous, even more bullish than ours, and was very clear in calling for a rip-roaring bull market through 23 and 24, which of course we've seen. It's continued into 25. And his calls were brave and correct as it turned out. The analysis was really different. And that's what caught my eye. And so since then, I followed his work. He's on Twitter. You can see his profile here. He runs a subscription service on X and also a terrific Substack. And there's lots of other ways you can get access to his work. So I'm going to ask Henrik to just talk to you a little bit about his own background just now, and then we'll dive into, as I say, looking at exactly what the bull market, in fact, looks like right now. So let's get... So Henrik, I'm going to hand over to you if you want to switch your camera on, and I'll make you a presenter right now.
Thank you so much. Hi, Alex, and thank you for having me on tonight. Yeah, sure. Why don't we start out? You said something about my background first. I mean, I'm actually from the consulting industry. I until 2008, I was doing due diligences as a consultant. Do as a part of an acquisition, and into 2008, we saw how the economists and media were just all bullish, and we saw what happened there with the financial crisis, and then I just started to think, we can do this better, because I think it was quite astonishing to see how everybody could seem to be so bullish on the market and just thinking that this can go on. And I was also convinced by that myself at that point. But then we saw what happened, and that just triggered something in me that we need to do this better than what we see. So my journey then was really to start out on starting to see how do you go about this? How do you actually analyze markets? And instead of just diving into what the banks and everybody else is doing, the ones that did not forecast the recession, I thought I had to figure this out myself. And I started out by developing first of all a market model, and then the business cycle model at a later stage. And really, when the business cycle model came in, it really started to make sense at all. Because what we can have, and this is what I want to show you now, is that we can have a bull market that can go on for a certain time, but when the economy rolls over, then the bull market is done, and that's it. So liquidity, which has been an important factor for a long time, is only going to work for as long as the business cycle really supports it. And this is where I think the schism is also going to come now at this point here in time, where I think we're going to see a lot more liquidity coming in soon. But I'm not sure. I'm pretty certain actually that you're not going to see that help a lot in the business cycle, because the business cycle is rolling over. And the business cycle, what is that? That is the real economy. It's not all the things we hear about in the media, and then with what the Fed is talking about and so on. It's really about Mrs. Jensen here in Denmark, Mrs. Johnson, or whatever they're called in the US, and elsewhere around the world, who has a mortgage loan and goes to work, and if the housing market is bad, well, then you don't spend as much, and if you lose your job, then you definitely don't spend as much. And these are the dynamics of the economy. And if you really understand that, yeah, sure.
Before we get into that, so we just take a look at where we stand in this bull market right now, because I think we still have a lot of people that don't believe it's a bull, think it's a bear, counter trend rally, just think it's going to roll over tomorrow, something. But let's just take a brief look at where we stand. So I'm going to just
show so you want that from a market side. Okay. You have a few charts there.
Yeah, I'm going to put a couple of charts up right here. So we're going to look at very briefly the S&P, the Nasdaq, and we're going to look at Bitcoin. So let's just get these on the screen right now. We don't need to spend a ton of time on these, but okay. So what we have here is the SPY ETF, right? Nothing very complicated here. And there's obviously many, many ways to look at a stock chart, but we use in our work at Zeberg, and Henrik uses this as well, the Elliott wave and the Fibonacci methods. Lots of technical methods. They tend to coincide around the same sorts of numbers, because what you're measuring the whole time is essentially human emotion. So how far does bullish sentiment stretch, and how far does bearish sentiment stretch? So any technical analysis method that you can use and master, if you get good at it, it'll be reliable. You don't have to use the methods that we use here. Very briefly, this is the COVID low here. SPY, the S&P is at 220, runs up to about 480 at the end of 21, early 22. We get a 50% correction, meaning it sheds around a half of the value it built up in this bull market here. And since then, we've been in this, what I think is a wave 3 up. Wave 3s tend to be the strongest part of a bull market. And right now, we've blown past what we could think of as the minimum expectation for this bull, which is around 6,000 on the S&P, or around 608 down thereabouts on the SPY. I think it's a judgment call whether we get to the next sort of critical level, the next fib extension at 670, or we could even go further into 770. And while that might sound preposterous right now, bull market tops always sound preposterous before you get there. And they always sound preposterous in retrospect as well. And that's the whole point. Bull markets are defined by blow-off tops whenever they come. So that's the S&P. The NASDAQ we have right here, if we just look at the weekly chart, just zoom out a little bit. NASDAQ's obviously been extremely strong through this period. So we have, again, from the COVID low back here in March 2020, we have the run up from 165 on the QQQ to about 410 at the top of the bull in 21, a 61.8 retrace. You can see the importance of these technical levels. It bounces there precisely to the dollar, starting out in October 22, finishes in January 23, and then rips to the upside. You get this Liberation Day correction and bounce back here. And so far, again, we've soared past the initial minimal target you could think of. We're past the next level, that 1.236 extension, and we'll see whether we get to the 650 on the QQQ. I don't know if we will or not, but it's technically possible that we do. So again, that looks a long way from here. Lots of people think the bear is about to kick in, tomorrow. Could happen, of course. But in general, bull markets do tend to carry on longer than people expect. And lastly, if we look at Bitcoin, we actually have a quant system for Bitcoin. You don't need me to tell you that Bitcoin is at making new all-time highs, almost got there over the weekend and today. Bitcoin, I suspect, is going to go higher from here. We cover Ether in great depth. I think that's going to go higher from here. So we're seeing basically very bullish sentiments in all markets right now. Let me just switch back to our agenda right here. And so the question is, how do you spot a potential rollover? Chart analysis is subject to, it's in the eye of the beholder. So we can all draw a chart which we think is going to collapse tomorrow. That's really easy. We can all draw a chart where we think it's going to carry on forever. And I'm going to show you just very quick analysis of that on the S&P, and then we'll get back to Henrik's take on the business cycle. So this is here's the SPY ETF again. It's a zoomed in chart, and it's more complicated, you can see. But you could say, I think, that this bull market is, let's say, you believe it's coming to an end. You could say, well, look as follows. This is the Liberation Day lows, April the 7th. A 1 up, a 2 down, a 61.8 retrace. It's a perfect Fibonacci drop, Elliott wave 2, a wave 3 up, I think. A 4 down here, and probably we're in a 5 up here. Wave 5s tend to complete somewhere between the 50% and the 78.6 extension of the wave 1 to 3. So you can see you can construct a technical argument that says, okay, well, we're probably nearing the end of this cycle. And this level up here about coincides with the longer term chart in the S&P I showed you. But this is just an opinion, and the problem with charts is that you can find any argument to suit what you yourself have concluded is going to happen to the market. And that opinion tends to be based on feelings. Well, feelings aren't very much use, in my opinion, in investing. They generally get in the way of things. So I'm going to hold over to Henrik now. He's going to talk to us about how to do this business cycle analysis and how to spot when things are starting to roll over in the real economy. So Henrik, I'm going to make you a presenter right now.
Sure. Well, so yeah, I agree with you, Alex, that it's not just about looking at the at charts like that, because there can be so many ways of interpreting the charts, and that's also why I said earlier that you need to have the foundation in the business cycle, because the business cycle, as I said, this is the one thing that will tell us whether you are in a bullish or a bearish environment. And actually, that was the reason why I started to develop the business cycle also, was because I could, you could put up Elliott waves. I could tell you could be in a bull market for longer, and whether this was a third wave or a fifth wave or however you could put it up.
Right.
And that was really the problem. And that's why I developed what I now will show you here, which is the, see, I do think I share right now, right? So the business cycle here, which is the, let's see if I can do it like this. We have what I call the leading indicators up here. And these are really based on also what the Conference Board are calling the leading indicators. we have the coincident indicators, and we have the lagging indicators. And first of all, there is a very important division here between how this works, because the leading indicators are the ones that leads the economy to where we are, where it's going. That means that when they start to deteriorate, we will have an economy that is slowly getting worse, but it's not something that we'll really see before we get to the coincident, which is employment, manufacturing level, GDP growth, and so on. And these are the ones we see here in the coincident. So every time in 70 years going back here, we're going to see this with 50 some years here on a quarterly level, when you have a crossover, and here you should only observe the red line and the horizontal line. Just forget about the blue line. This is something I use for something else, but the horizontal line, when the horizontal line here is crossed by the red line, that is when the economy weakens, and we get what I call the recession signal from the leading indicators, which tells us now we should start to expect that the coincident indicators, that the real economy starts to weaken. And every time you've had that for the 70 years of data we have had, no false movement, no false signals at all, you get a recession. It may take a little longer sometimes, but the economy is then starting to deteriorate and to slow. And what you then need to do is that you start to investigate or to analyze the data you get down here in order to understand when is it then we see that the economy starts to deteriorate. So when I saw this here in November 24, and actually I could see this for long, that's why I also, publicly on Twitter I said, well, the economy is weakening and the recession will come, because we had this and it went down to the zero line and it just bounced off it. But then in November last year of 24 here, we really crossed below. And we never have had a false signal. Even Corona it got financial crisis. So when the recession comes in, when this comes in, the signal comes in, some quarters passes by, and then we get a crossover. See, the thing is, if you want to invest, you want to invest from the moment that the economy starts to strengthen again. So you want to get in here when the red line here goes up, and this is the moment you say, okay, this is now safe to be in the markets. And actually, it's safe then to be long the markets in this entire time frame here until the moment it crosses over on the coincident. And this is a new way of actually looking at things. So if you did that, and let me see if I could just find it here. I've got a lot of things going on.
The timing of the timing of that signal looks good on the bullish side as well, right? So when to pick lows, because at those periods when that line bottoms out, that was peak fear. I'm old and I've done this for a long time. And so if you look at the depths of the 08-09 recession, I mean, people genuinely thought by the end of 2008 that capitalism might just break, right? But your signal here bottoms out.
Yeah, exactly. This is where you can't see it here because it was so low, but
it's so bad.
It was so bad. But actually, there are some signs also that the thing is, when this one here, and this is the thing that I haven't told a lot of people, they actually see that when this one crosses over on the leading indicators, that you can draw a horizontal or a vertical line down here, and that is actually about the time where you see the bottoming of the business cycle. Remember, this is the real economy that we see. So in the moment you get the crossover here, you can actually pretty much say, oh, this is actually the bottom of the business of the real economy. So this is quite strong, and this gives us, and also then when you have that bottom, then you can start to look for the bottom in inflation and yield levels. So when people also were talking about that we're going to have that yields are going to rise from here, inflation is rising, right? That is not what you see when you have an economy that is rolling over, and especially when it looks something like this now. On the latest number I had here on the quarterly basis here, on the after July numbers, was actually we got down and we now have that it's crossing here on the horizontal line, which means if we go back in time that we are, if it's confirmed by end of September, we are then in a situation where you can see, like for instance with the recession here into financial crisis, you had it the November 2007, we had the crossover and the recession started in December 2007, February 2001, March 2001, May 1990, July 1990. Corona, it was November 2019 and it started February 2020. So this is a strong signal. This tells us that the real economy is rolling over. And let me just talk about just for a sec here also how you use it actually if you want to in the market. Because the moment, we want to be either long risk or long bonds. And
I love this chart.
And if you go and if you actually use it here, and just the way you just you use this this model is really that when, as I said before, When the red line here is crossing up, that means that the economy is now strong enough and it's safe to be in the market. And then you can stay in the market for this and time here until we get the crossover here. The same up here, you'll see that you had the crossover here. You could stay in the market until this time when we saw the crossover here. And if you go back and you actually look at that, and you what we call the Zeberg-Solomon protocol, you will actually see that this is long TLT, long bonds, long duration bonds I've been putting in here. Yeah. You will actually see that by following this, you would have made 42,000% in the market with just, and I've just followed it consistently here with this.
But 2x, you've 2x the market basically.
Yeah, actually more exactly. Buy and hold would give you 6,000% since 75 here over 50 years, and this one here would actually 7x. So you 7x.
Okay, so if you use so if you use this system for in and out of the S&P equities only, then okay, so it's 6, so 3.5x, and then if you long bonds when you're off equities,
correct,
you double that again.
Correct.
Yeah, tremendous.
That's because the bonds will actually, you'll see that they will overperform in these periods, even though you can see that the stock market actually rises a bit here. You'll see an overperformance by the bonds, and here you'll get you'll get in a little late, and here you get in a little even more late, but you actually see it at a time where you get, and also here. But what you also see is that we actually get out at the time when the recession starts. I mean, we are out at that point. That means that if something's bad is coming here, and we see the crossover of this, what I think we're about to see by September, well, then probably September could be a good month to withdraw from the market, at least if you believe in this system and in this setup here.
So I'll tell you why I love your work, Henrik, which is there is a endless river of economists who will publish macro data and opinion forecasts and whatnot, and some of them are right, some of them are wrong. Famously the dismal science, all of that. But the main thing for me is it's not all that much use as an investor, because it's very hard to build any sort of model or any connection in your own mind between, okay, well, this bank is forecasting that for GDP or this for inflation. Okay, what does that mean for the market? And so for someone like myself, I tend to not ignore the macro stuff, but it's not very actionable. So I tend to rely more on technical analysis, quantitative analysis, those sorts of things. But what I love about your work is you bring the two worlds together. So you aren't claiming, perfect vision on technicals. You aren't claiming perfect vision on macro. But what you're saying is, if you look at reality through these two lenses, you layer one lens over the other, then you've got a much better shot of calling highs, calling lows, than either method by itself. That's what I think is really skillful. That's what I love about your stuff.
And thank you for mentioning that, because that was actually, back in the days when people were talking about, we had you remember there, you talked about 22, and you can see what my model, where that was at this point. You had 22, we were probably around here with the leading indicators. We were not even close to the line back then. And you can see that the coincident indicators were up here. So it was the easiest call to say, this is a correction. This is a pullback in the market. It's just about me now to actually understand where it is that I should be starting to get into the market. And like you, I thought it was in July, because that was, there was you probably got fooled by the same kind of value.
I did. I got completely fooled by it.
yes. But anyway, but that's what it is. And but July, I was massively bullish, and then they came out, it was October, and that was all good and fine, because you could buy in at a very, very nice time there. But now it starts to tell us that this time here is completely different. So people that think that this is just a small, but the market's just going to bounce back up again. First of all, we have to understand that this is a massive, situation. If we're going to see that, we had something in 2019 into 20, but the same thing was here. And actually, this is something I've been considering, is that the Fed actually got in early at that point because of the Corona. If you had not had Corona, I don't think the Fed would have gotten in as soon as they did. This time around, the Fed is in way, way, way too late already at this point. So yes, they may go out and try to counter this, but the situation is also, and this is where I can maybe just show another chart that I've done, and I think is actually quite telling for what we are looking into. Let's see if I can find it here. There. That is simply that we have come to a new inflationary regime. If you go back in time here, you look at the 10-year yield here for a very long time, and we know that 10-year yield and also inflation, they will be moving, pretty much in, alignment. you'll see that, all the way back here, you have the spiky peaks in a deflationary and regime developing. You see momentum is down here. The moment it kind of shifts up to this area here, which is, noticeably higher level than what we had, you are in an inflationary regime. Then, famously, Volcker killed inflation. Actually, you could see it on the divergence into this top, but that's for another day. And then we saw noticeably again that we shifted into a bearish environment, which is what we have seen. Now, guess what? What happened after what I call the inverted Volcker moment was right here. We have shifted up into this environment here again, which means that we now have an inflationary regime. That does not mean that inflation is going straight up from here, because I think we have seen the first spike of it. But as you and I probably know, Alex, then this is probably a wave one. You have probably a wave two coming here. But then I think over the next many, many years here, we're going to see a wave 3, 4, and a wave 5, something like that. So what I'm talking about here is that we are now in a new inflationary regime, which means that if the Fed comes out and starts to pump money into the system again, they're going to create something that our grandparents knew that they couldn't do, or our parents, or whoever was doing the trading here, because they knew if they started to pump money into a system like this, they would get inflation. And we had just forgotten about that because things have been going down for such a long time. So we are in a new regime, and this is the problem this time around. That is that this time we do not have the free lunch that we had back in the days.
Yeah, I mean, we saw, the Fed rescue in the Corona crisis, necessarily led to that big wave of inflation. It couldn't not. There was so much stimulus, fiscal stimulus, monetary stimulus. No way it could.
Into a supply crisis. I mean, supply was pulling back because people couldn't go to work, and we stimulated demand. I mean, even to think that they didn't think it would have an inflationary effect was ludicrous.
And again, you can see the emotion at work, because think back to what it felt like in February 2020. It felt like, to me at any rate, it felt like, okay, if cash stops flowing in the economy because supply is constrained, because people can't go to work, all those things, then the economy might actually break. So you can see that if you were sat at the Fed, you'd go, well, I have one answer to this. The famous ECB bazooka. I can fire a big old ton of money into this problem, and I can solve the problem. And they sort of did. They kicked the problem down the road, just like in the 08-09 stimulus. You kick the can down the road. And we also see now the short-term decline in inflation. And I agree, the Fed's lagging because they look at lagging measures. You're looking at real-time. I know you post a lot about the trueflation measures. You're looking at real-time data, and you're seeing a rapid reduction in inflation. But again, if we see a real equity correction coming along, I don't mean a couple of percent drop, I mean a serious drop, then we all know what will happen, which is there'll be Fed stimulus. The Fed chair is about change. They're likely to be a much more dovish chair, and we're likely to see stimulus for all the usual reasons. And if that does propel us into a structurally inflationary environment, then people aren't ready for that. That hasn't.
No, absolutely not.
Most people investing now weren't around the last time we were in a real inflationary cycle. Money can be made, but you have to make it in a different way to how it's been made in the last 15 years.
And this is where real investing comes back, because when you are in this kind of environment here, where what we call it CERP and all that, where we have zero interest rate policies and all that, of course you are going to get distorted landscape, because everybody who has $1 million wants to say, where can I get yield? And if they can't, normally you would look for 4 or 5%, but because everything was just so, yields were just artificially suppressed, you would accept 1 or 2%. And all the bad investments were then, that's why we have yields and we have interest levels. That's because you need to weed out all the bad investments. The problem is that you can have money then flowing into bad investments, and that's why I'm saying also these days, famously, I think we have a massive bull going on now in crypto, but I know it's going to come to an end. And I think you have the very existence of the crypto market is a bubble. It's the definition of the bubble, because it has something that has been born in an environment where we are here, which when we get up here, I mean, who is going to buy WIF or any meme coin when you can go have a fixed yield on a mortgage, on US bonds, for instance, which is above 2 or 3 or 5%.
the Liberation Day correction this year was really instructive, and I think it doesn't surprise me at all. You see all this analysis that says retailers outperformed professional investors, and I believe that's the case this year, because I know for myself, right? I'm a long time trained investor. I think as a professional with my own capital, and sometimes that's great. It helps you avoid the worst of times, but it limits your risk appetite somewhat. So the people that have done absolutely brilliantly this year did the exact opposite of what the Warren Buffett would tell you to do during a correction that we saw in April. So if you read any of the Buffett, Graham, and Dodd, all that classical stuff, it would say, okay, well, when that crash comes along, the S&P goes back down to the level it was in the end of 2021. What would you buy as your Warren Buffett? You'd hoover up as much Apple as you could find, right? You'd buy, as much ExxonMobil as you could find, right? You'd buy the best quality companies with the most reliable earnings, the best fundamentals, and you'd fill your boots with that. And actually, that would have been about the worst move you could have made. You should have
absolutely.
In those April lows. In this environment, was the most trash you could possibly lay your hand on. Buy that, and then anyone who's done that has done brilliantly.
Absolutely,
and that environment will continue until it doesn't. It's really hard for any investor to go, okay, I'm in an environment which rewards basically buying low grade investments, because we're in a world that rewards high beta, and spotting when that changes and says, okay, I need to get out of those. I need to take my money out of those. And this happened, of course, at the end of 21. I need to get out of the trash and into something much more solid, or cash, or I need to be short, or something. And it's keeping cool enough and unemotional enough and analytical enough to go, okay, the environment's changing. I'm never going to call the top, just like I'll never call the bottom, but I have to be ready. And again, this is why I love this analysis. I have a question for you, by the way, a written question, which is on your coincident indicator chart. The question said the red line is the recession line. What's the blue line? I think you said that was just an internal.
It's an indicator line. It's something I use, but also to understand when you'll see some of the crossovers down beneath. It'll take it too far to go into. So it's more of it's a indicator line for when we should see some of the other indicators starting to move as well. So it's an average point. It's really just to focus on the red line here, to say the red line will give us the business cycle for the leading indicators. Just focus on that, and then you have it for the coincident indicators here. You also see this is only a shallow actually recovery after .com, and then it came down strongly, and we have something similar here. Look at this. We had the decline into Corona, and we have had a shallow recovery, and it's actually moving over. I'm saying also because, and I want to say this out loud, we have now the combination of the largest tech bubble ever combined with what we saw in 2008. We do not have the speculation in the real estate market to the same degree, but we have a supply overcapacity in supply, and also that the customers are not well off and not capable of supporting the real estate market, which means you have a combination of 2001 with 2007. That is what we have right now, and the bubble is even bigger. So when I'm asked why do you think we have a big recession ahead? Because a recession is coming. First of all, you have the largest bubble, and you have a combination of a tech bubble and a real estate bubble. So go figure.
Yeah, and so the question, I agreed. I mean, those are facts. Those are hard facts, and they, one can have an opinion about things, but those are facts. And so, of course, the judgment call comes. How long do the plates keep spinning, right? How long does the bubble stay inflated?
Yeah, but I think we can do something about it. We can look at that, right? Because we have if we believe, first of all, I believe in technical analysis, because it's giving us
it works.
It works, yeah. And if you look at, for instance, we're going into the .com here, we had on a monthly basis, we actually had some negative divergence, which means that momentum is starting to tell us it may be that we're moving up, but the strength of this market is actually waning. Here the same into this top. Now this, what we're looking at here, guys, this, I actually think it starts here, Alex. I think this is a 1, 2, 3, 4, and then you have a subdivision into the first, and this is actually second wave, third wave, fourth wave, and then you have a 1, 2, 3, 4, and this is the fifth wave, and that will take us up to around the 7,500, which now goes hand in hand with this, what we are talking about here. So if we can get to that
It does.
level within, October or something like that, then we could probably. But we have, but we have a massive, where am I at there? We have a massive divergence here. And this is
Yep.
the thing is, if you look at a very long time frame here, that's not it. There, going all the way back to 1870, and we look at also what is Kondratiev's periods here. There you have that where when you have the winter period, that's the bad period. And then we have the spring, and after the Second World, we had the depression here. It went down 85%, and this was when the market capitalization was 89%. Then you have a market capitalization, it says gap here, it means cap, and the same here. It was at 136% at wave 3 here, and now we are at wave 5, where we have a 226 if you include the crypto market. And I think it's going to go even more crazy because the crypto market, I see that go up a lot, and also the stock market still. But if we end up somewhere up here, we seem to be at the maximum of what at least this kind of suggests us to be. And if we go down with what I think is reasonable here, we could see 76, which would be a Fibonacci level down here. We could see 84, which would be comparable to this over here. And remember, the stock market bubble is much, much bigger this time around.
Mm-hmm. Yeah.
And so I think it's gonna be a really, really bad one we're looking into. And the problem is down here we had debt was the problem after the Second World War. Guess what? Debt is the problem again, and we need a monetary reset more than ever. And let me just say to all the Bitcoiners out there, if I can say that also, because I think we are, let's see if I have one here, but there we go. So people are saying, oh yeah, but Bitcoin is going to do well. I mean, I really do not understand this, what we're talking about right now. I mean, Bitcoin is a risk asset, and it goes, if liquidity, and it's a very good liquidity gauge. So when NASDAQ goes down, Bitcoin goes down even more. When NASDAQ goes up,
as we saw
more.
in 22, right? So I mean,
yes, exactly.
For clarity, I'm long Bitcoin, I'm long Ether, because I think they're going to go
Same
up
here.
near term. But for clarity, all the talk about Bitcoin being an inflation hedge, well, it wasn't in 2022. So we can have an opinion about things, and we can look at facts. And the facts were, when inflation spiked, Bitcoin fell. Right, that's the fact.
And
Ether fell even more.
Yeah, exactly. And I know, and crypto's gonna get annihilated. And I'm very, very bullish right now. And I have 170,000 for Bitcoin as the top.
Yeah.
But if you look at this also, this is Bitcoin inverted, and you look at the kind of divergence you have on this one here. I mean, this one here is a very, very bad chart for anybody who thinks that Bitcoin is a long-term asset.
So just for anyone looking at this, I saw this chart at the weekend. It's an inverted chart, right? So if you look at the y-axis, okay, when
log chart,
so when the thing is going down, that means price is going up. Okay, so this is showing an approach towards a high, and then flipping bearish means it's going back up on the chart, just to be clear.
Yeah, so this is a new extreme all-time high coming, and I think it could stop here at 160, 70,000. Maybe we could go even higher. Maybe we could go to, I could not rule out we could be in a log chart which will tend us up to 350 or something like that. I could see that.
Yeah.
But I can also see that this here is the end of this. I mean, this is a big end coming to Bitcoin. And I just have to say, with this kind of chart, the 16,000, that's in the cards if this is happening.
People in my experience, people will look at charts like this, and only the ones that we share today. And when you're at this point in the cycle, no one believes that the ball can carry on as far as any of these projections. Okay, so if you were talking to someone about 350,000 Bitcoins there, they think you were insane. But equally, if you said to someone about 16,000 Bitcoin, they think you're insane. People forget while they're sat quietly thinking about things. People forget about markets are driven by fear and greed, pure sentiment, and sentiment begets momentum, and momentum begets its own momentum. So calm, quiet analysis isn't how markets work. And so if you can be calm, if you can sit back, if you can construct your parameters for where you think a top might be and where you think a correction might happen, you're ahead of 95% of the market who are running around like headless chickens, scared in a bull market that they're going to miss out on the upside, scared in a bear market that they're going to go broke. Most people, I include most professionals, And many algos, which don't forget are programmed still in the main by people. Most people are in a state of perpetual fear in markets,
Mm-hmm.
fear of missing out
Mm-hmm.
or fear of losing money. And a huge advantage of this kind of calm analysis, particularly the combination of your macro and your technical analysis, is you can do it calmly. You can make a plan.
Mm-hmm.
You can think clearly. And the thing I think that most people don't do in markets is they don't think clearly. They get caught up in the crowd, and otherwise sensible people make terrible mistakes that they would never make in their own normal life, because they get caught up in the bullish
Yeah,
or the bearish
sentiment.
environment.
Yeah,
They
yeah,
make
yeah. But
mistakes. Exactly, sentiment. They make mistakes on both ends.
yeah, exactly. And I can understand that. I mean, it's probably a thing from, whenever we were, out on the savannah somewhere in Africa,
Yeah,
standing there, and if you were standing with the crowd and the lion came, well, then you would be fine. Potentially, you would have 1 out of 20 that the lion was going to pick you. But if you were standing alone, you would be very vulnerable. And I think that's it. I mean, people do not like to stand alone. They don't like to be wrong on things. And instead of just looking at this and saying, we have seen this before. We
yeah,
know that Bitcoin has not done well in an inflationary environment. Why on earth would anybody think that we're going to see Bitcoin doing well if inflation is coming? First of all, we have also seen Bitcoin not doing well when during deflation into the Corona crash. Why do we think all of a sudden it will do well here? And
yeah.
if we are in
That's
a
right.
world where the Fed is about to create inflation because they've come in running in, why should we think Bitcoin will do fantastic there? So I'm just asking also people just to think instead of just just to feel and try to feel good because they stand with the crowd.
Right. And I think the other thing is you have to think in one thing that's very difficult for anyone to do. Doesn't matter how long you've done this. Is you have to think in multiple time frames all at the same time. So my take on Ether, for instance, which we cover in depth, is Ether is in a really strong bull run at the moment. Why? Well, because it's been institutionalized. Okay, the old world just took over the new world via the Genius Act, via tokenization, all of the hopes and dreams of the original Ether maxis. Good luck with that. It just got taken over by Larry Fink, right? The old world owns you now. So that's very, very bullish in the short term. You can see that with the Ether treasury companies. You can see it with Ether itself. That's going to keep running for a little while yet, and it's going to surprise people, I think, to the upside. And then,
Agreed.
then the system will have amassed all the things it needs, and then it sort of doesn't matter what happens to the price of Ether at that point, because the system will have amassed what it needs to run the system its own way. And then we're going to see a big price correction. And so you can be very, very, very bullish on Bitcoin or Ether or anything else in the near term, as long as you measure, look, where can it get to? And how do I spot, your divergence patterns, for example? How do I spot when is this run weakening? Okay, now I need to sit back, take some profits, hedge, whatever. But don't get caught up in the crowd. Yeah, I agree.
Don't get caught up in the crowd. I couldn't agree more, because I think
Yeah,
there's too many, and that's why I tried actually to send to. I mean, we are, as you also said earlier, we are selling publications. We actually have quite strong impulse signals telling us when different coins are starting to move and how far they move. Is that then and we get a Telegram service also running with that. That's quite good actually. And I would say that we know that it's something that is there for a limited amount of time, and then we'll tell people also and say, hey, this is it, and don't we don't want to burn our hands and fingers on this. So it's
yeah.
about
I have a
exploiting the
question for you
opportunity
here.
right now. Yep.
That's right. I have a question for you here, a written question, which is, are we in an alt season right now? What's your look on the current crypto market, Bitcoin, Ethereum, overall coins coming in the next 1-2 months, etc.? So I know you
Yeah.
do a ton of work on Altseason. I know people would be interested to hear your take on that.
Sure. Yes, I think we are in the Altseason. Let me just see if I can find the chart that I was looking for. First of all, hang on. I mean, yeah, wasn't. Like we have so many things open, right? So anyway, but the one thing we could look at first of all is, of course, the ETH Bitcoin ratio, and that's what we want to look at. That gives us an idea of whether we have started that move. And yes, I think there's somebody who made this. This is not something I've done. I said that also on Twitter today. I think it's actually quite clever. This, We have Bitcoin attracting capital, then we move into Ethereum. That's where Ethereum starts to outperform Bitcoin, and then at some point people start to say, oh, we didn't get the Ethereum most of that run, so people start to look into large caps, the Solanas, the Sui, and others, and then you'll see Altseason, and then you're going to see memes and everything just explode, and that's going to be the top. And this will not last very long. It's going to last, actually quite a short time. So we can see over here when we had a massive move, and this was 2017. Then we had what I think was just more of a bounce, which actually also was a quite strong Altseason, this part here. But I think this one is going to be bigger and stronger. So I think we have seen that, and especially if you look to the Bitcoin dominance chart here. So if we come in here, can't remember which one is this one here. So if we look at that, we have also seen into what I think is an expanding diagonal, which is again an alien wave thing. And then you see that into this again, remember this with divergence here. When we have divergence into something, we pay attention, especially if it hits the 5th time, and then boom, then it starts to move. So I think we are, this much into the Altseason. The Altseason actually really started here in, you could say in June, actually around that time when it started to move down. But we haven't seen the small. And I think what you see first is that first ETH is starting to move, and that's what we have seen here. This is ETH moving first, and that will then attract the capital. So we see ETH and some of the large caps starting to move somewhat. And then it will be more and more about the altcoins, so the large altcoins, and then you're going to see the memes. And I think we can see a target down here at 32% for Bitcoin dominance, maybe even lower. I couldn't rule that out, but I think we're going to go this far. So, and that means that if we see a ratio going up to around 1.12 with my Bitcoin target around 170, that means you're going to see Ethereum at around 17 to 20,000. So I think you have, as you say, I think you have a massive bull market also running in Ethereum here. And I think, this is my take on it. I think we're going to have a bad September. Remember this. I think you're going to have a really bad September. And then I think you're going to see a fantastic move into October, maybe late October for the top. Why? Because business cycle, because that's also where I see the S&P could potentially topping, and also liquidity, plus also the the Bitcoin cycle tops around that time. So I think October could. I'm not saying it will. I'm saying could. I'm putting up theses, and I don't. That's how you do when you do any kind of science work. You always put up a thesis, and then you invalidate it or you validate it, and then you move on. But I think October could be a potential top, and I think.
Well, you can sort of see what's going to happen in ETH at the moment. So basically, everyone's been asleep on it. No one noticed the importance of the Genius Act. People are just starting to wake up to it. Bitminer is leading the charge of the treasury companies. Ether itself is up. And so what's going to happen is people are going to gradually pile in over the next few weeks. Then that'll all get shaken out because that will be easy money for someone that goes, I tell you what, we're going to sell this a bit, scare everyone out, buy it back up, and then a final round. I mean, this is normal for markets. Right? And we have a great question here. We're almost out of time, but great question. We have some questions from Torsten, and I think Torsten, Henrik's covered most of your points. So I'm going to go to this one, which is from Driss. Great question. He says, which will be the stocks in which to invest during the reinflation phase? Now, I'm not going to put you on the spot, Henrik, not to come up with any tickers, but I love your chart about, okay, look, inflation is coming down right now. We can argue about how quickly, but it is coming down. But if you zoom out, it's probable, not definite, but probable that we're going to see a reinflation phase over the next, let's say, 5, possibly more years. And so Driss's question is, what kind of things, what does one do in that sort of environment? What kind of stocks or what kind of investments? What do you look at during a reinflation phase? I've got some.
Yeah, but I'm not sure
I'm interested in how you think about that.
Phase is going to be that long. And I think this is because we're thinking with the glasses on of, that the Fed will be able to solve this again, like what they did the last time. And I think the time for the free lunch will be over. That's what we did as we had the deflationary phase. So what I think you're going to see is that we just have to think about it. If I get it right, we get inflation coming down, we get a market top with, let's say, October, we get a market crash. It doesn't come immediately, but it starts to accelerate. The Fed starts to panic. and understands that they are really far behind the curve, and then they will they'll be flooding the markets with money or with liquidity. What I think you're going to see is that you're going to see a move in the market, yes, but the market is not the real economy. The market is the financial side of things. The real economy is back to the labor market, and it's back to, and I don't, in order to get the real economy to react on what comes in through QE or whatever they're going to come up with, the geniuses, then you have to have Mrs. Jensen here in Denmark saying, oh, I saved $100 or $100 on my mortgage loan because the rates are coming down. You know what? I'm going to spend it. If she doesn't,
Yeah.
if she doesn't, then QE is impotent, which means that, all this money is going to be, because, and you know, what has she been going through over the last few years? She saw inflation. She saw maybe unemployment. She saw, rates going up. So what would incentivize her to actually take those $100 and spend them? That is why I think the real economy is going to go through a much, much slower phase of bottoming out. So I think the reinflation you're talking about there will be a shorter period where the stock market and investors will think, yeah, the Fed is back, bounce. But then I think it's going to get worse after that. And honestly, and Alex, you can help me there, I think the A wave in that will be the deflation. The B wave will be the reflation, but that will be a bounce. And then you'll have the C wave, which will be the stagflation. And I think the stagflationary phase will come a year later or something like that, 6, 7, 9 months. And I think that is going to be the worst part, because what do you do as the Fed in the stagflationary phase? You can't do anything.
You're trapped. You don't have any tools.
And that's why it's going to be worse, and that's why the Fed is not able to do anything, because we are in a new inflationary regime. So I don't think like what we did in 2008, because the regime has shifted. It's a new environment.
Yeah, that's a great answer. Thank you. We're not going to have time to cover. We have some questions coming saying basically, okay, well, what should one do when the market peaks? We'll do another session on this at some point. But my own views, for what it's worth, are. I'm going to switch my camera on for a second. My own views for what it's worth are, first of all, it's really difficult, and one shouldn't be afraid to just get out of the market altogether when it's in a correction mode, because for most people that's the easiest thing to do. You know, as a friend of mine, Jake Majestic, will always say, cash is a position, and you can make all the arguments you like about inflation destroying the dollar and blah 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 blah, but cash is a position. Cash will at least keep you somewhat safe. I'm no kind of commodity expert. I'm not really going to comment on gold or anything else. But my own view is the hardest market in which to make money is a sideways market, a range-bound sideways market. And we have seen that the S&P do that for years on end. A market that's crashing, you can learn to profit from. And in my experience, the easiest way to learn to do that is to learn how to hedge and learn how to play the market to the short side. And by that, I do not mean risky options or future strategies or any of those things. There is a wealth now of inverse ETFs, which is to say an ETF that will go up as the market is going down. You can get yourself in all kinds of trouble with these. And so for anyone that is inexperienced, I would say now is a great time to start to study very simple inverse S&P or inverse NASDAQ ETFs. So the simplest one is there's one called SH, it's a US ETF. It is a one-time short S&P ETF. So that means if the S&P goes up 1% today, then SH will go down 1%. If the S&P goes down 1% today, SH will go up 1%. For the NASDAQ, you can use PSQ. It's a US ETF. Again, same applies. If the NASDAQ goes up half a point today, PSQ will go down and vice versa. They are daily inverses. And you can find a wealth of research that tells you shouldn't hold them long term, and so on and so forth. And you must, in my opinion, read the fund documentation on their website in great detail and understand how they work. But if you get into that, and we teach this in our work all the time, if you get into that, then you can profit from bear markets without doing anything too scary. Most people wreck themselves in bear markets because they try to be too clever. They think that it's just a short-term correction when in fact it's a proper bear. They think they know which companies will outperform, and they think that you can hold those stocks because stocks are the companies. That's not true. Most people ruin themselves in bear markets. Even those people that time the coming of the bear market really well, most people still mess up, because in a bull market, it's really easy to make money. Just don't get in your own way. Don't overthink it. Buy something simple that's going to go up. Buy the S&P, buy the Nasdaq. It's probably going to go up. Bear markets are much more difficult. So I would say, if you want to profit from the bear market, start learning now. Do two things. Look at Henrik's work. There's lots of people that will tell you there's a crash coming. You can find social media full of that. That's not very helpful. If you look at Henrik's work, you can see some macro arguments, some technical arguments, some timing, and you aren't hearing him say it's doomed tomorrow. That's useless analysis in my view. You're hearing him say, I think there's an up period because, I think there's a down period because. So study his work. Doesn't mean he's going to be right, but study his work and think about it. And then think about how you yourself can benefit from any market correction in a way that doesn't require complex instruments, lots of leverage, lots of risk. One point Henrik didn't make just now was there's a ton of debt in the system. That's true. There's also a ton of leverage on individual investors. And leverage comes in many forms. It comes in the form of people owning options, not shares. It comes in the form of people owning levered ETFs. And it comes in the form of people owning, in particular, levered single stock ETFs. So there is more leverage on individual investors than there has ever been, even compared to the 2021 high. And it's that leverage that will wreck people when the market turns, because they won't react fast enough. They haven't learned how to hedge. And so prepare, study Henrik's work, look at some of these instruments. You can find a ton of stuff on our own website about how to do these things, but prepare. So the best comment I could give for how to profit when it comes around is do your homework, and do it now before the bear market's upon us, because nobody can think straight once the bear hits if you're not ready. Henrik, I'd like to thank you for a tremendous session today. I continue to be a great admirer of your work. I think it's unique in your combination of macro and technical overlays. Anyone can be wrong, of course. I'm not suggesting that you get me right. You don't,
No,
but it's great work, and people should really look at your work, sign up if you can, and I think everyone can benefit from Henrik's analysis. So thank you so much for joining us. I'm really grateful for you spending time with us.
Thank you very much. Thank you, guys.
Okay, folks. Thank you, everyone, for attending today. Great attendance. So we'll get the recording compiled and posted, and that'll be with you in a few hours' time. If there's any questions that we didn't get to, you can reach either myself, Alex Sestrian, on X, or Henrik. I'll post our X profiles in the video, and you can see that. Thanks everyone for attending, and see you all soon. Thank you.